All right. Good morning, everybody. Now it feels like a Friday. We're going to get some jobs data this morning. It's an accumulation of data that we've been getting all week, but it's the final one. That always sets us up for the possibility of getting these liquidity bars. And I like to revisit this from time to time, even just for the bare minimum that maybe I can stop somebody from trying to go in the direction of the move. So usually after a stream like this, someone will reach out and say, so how am I supposed to trade it? Are we supposed to trade it? What are we supposed to do with it? You do what you want with it. One, it's analysis, right? So you can identify that at 8:30 when we get these big economic events and possibly a very large bar like this, that it's what I call a liquidity gap. It's not a price gap. So we get this really large outsized bar. It closes the farthest away from where it opened as possible. I like the last 25%, right, being in that area. And then we use that bar, mark the midpoint of it, mark the expansion beyond it by 50% and 100%, and we look for price to come back down to where the bar started because we got to close that liquidity gap. Now in this example, we didn't make it back. On the breakout and continuation, price stalled at around 50% of the original bar's extension. And when it faded back, it got caught up on the midpoint of that bar. This is what it looks like when it makes it back. Notice there's no real gap going in the wrong direction. We closed in the farthest 25% of the bar. We didn't even really consolidate, just immediately started moving back. Got hung up on the midpoint for a little bit. We got the gap closed around 10:30 or 11 o'clock. That's why I always say watch the clock, right? There's so many little tells that go into trading that are connected to time. So even if it doesn't make any sense, just watch the clock. It's free. Everybody's got a clock. Here's one going down instead of up. No real wick going in the wrong direction. Close the farthest end. A bit of a base or some consolidation, and we began working our way back. Got hung up on the midpoint for a little bit. Got the gap closed between 10:30 and 11 o'clock. We're talking 2.5 hours. 8:30 to 10:30 or 8:30 to 11. It's a couple of hours. We're not looking to get this thing immediately closed. Here's another one. This one was actually CPI. And it's a little different. It took multiple bars for the move to finally dry up. Some consolidation. We didn't even get hung up on the mid of this run. We got hung up on the mid of that very first bar. That's where we kind of stalled out there for a little bit. Got the gap closed between 10:30 and 11 o'clock. Imagine that, right? Seems like a little bit of consistency to it. So we have the potential for a bar like this morning. The thing is, we always have the potential for one of these bars. The difference is when you have an economic event, you kind of know when lightning can strike, like Back to the Future, right? You know when it's coming. It's at 8:30. So while it can happen at any time, say news, headlines, all kinds of things can cause this sort of behavior throughout the trading day, and you can look in the charts and see it all over the place. When you know it's coming, it's really helpful, right? So at 8:30, we might get one of these bars. All of these pictures were done on a 5-minute. Generally, when I'm running analysis that requires a specific shape or pattern on intraday trades, I use the 5-minute chart, right, for the consistency of it. This is not my trade chart. This is just analysis. This is what it looks like when we don't have a gap to close, but we have a really big bar. There's no liquidity gap here, because we basically closed where we opened. What would we need to close, right? We're already there. But we can still use this really big bar. We can mark the midpoint of it, and we can project the entire measurement 50% and 100%, which is what we stalled against that day. We wasn't able to get beyond the 50%. Or another example like this is not a liquidity gap. There's no real gap here because we closed near where we opened, but we can use that bar anyways, right? So that's the idea behind it. I'm not saying you have to trade it. I'm not even saying that it's tradable. Just now you know what it looks like, or if you hear me reference it in the chat, you see me talking about it, you'll at least understand what the hell I'm saying so that we're on the same page. Kind of helps. Do you understand the words that are coming out of my mouth? That's a good movie. So we're a little red this morning around the world. Hong Kong down 1.5%, Europe around 1%, and then us less than that. So if you think about the trip around the world, opening in Australia, getting into Asia, and then Europe, and then us, it's down the most, the farthest away. So the Asian session, then Europe, then us the least. Keep your eye on Europe after they close today, or keep your eye on price as Europe closes today. That makes more sense. See if we get a change in dynamics at that point. These numbers are part of the reason why I think we could get one of those outsized bars this morning. These are really far apart. Now, normally I would want something like non-farm payrolls. You know, that's a real big one. But any employment data is worth focusing on. And anytime you have really wide numbers, it should get your attention. There's a lot of room for screwing up here. And I would bet the consensus is not uniform across multiple sites if we was to go look. So we might see some real drama this morning at 8:30. There we go. Right. Let's see, what else did we have today? There's a couple of Fed speakers, Collins, Schmid, Hammock, Paulson, Daly. No auctions today. Looks like Waller's getting it out early. He's probably headed somewhere for the weekend and wants to finish up quick. It's fine with me. Quit chipping his teeth and get out of the way. All right, well, they're not doing anything with the rate cuts. Nothing really stood out, anyways. Yeah, I don't know if you guys were trading yesterday, but that move in Brent coincided really well with the futures on the first push, right? And then they kind of decoupled a little bit after that, but it was a nice tell, keeping our eye on the crude and how it was impacting the markets. Kind of a toss-up between the crude and VIX right now on which one to watch, but it's not like you got to sit and stare at it all day. Just keep circling back, checking the chart, keep your eye on the news. Right there. It says tomorrow because it was written, last night, but participants will receive the non-farm payroll print and retail sales. Prepare for volatility. It's because those numbers are so far off. Have a low risk out of the White House this morning. It's set to 25 at the moment. So from this one, unless they just run an impromptu meeting, we shouldn't get anything from the White House for increased risks. All right, the put wall rolled again last night, just back to where it was. It's just fluctuating up and down at this point. Overnight volume really in line with yesterday. It's still elevated. It's a lot more than we should be seeing. The average is around 50 and we're still hitting at 150. So certainly elevated volumes. And we're looking at kind of the same price action as yesterday too, right? Kind of fading through the Globex as I'm streaming. We're a little lower than yesterday, closer to the previous day's lows. Underneath all of the moving averages and the options levels, zero gamma, volatility trigger, the call wall's way up there somewhere. Got a lot of drama down here. Every time we get down below this level, they bring it back up again, right? It's like they're defending this level, this zone. At some point, there's not going to be anything left down here, and they're going to have to go lower to find someone to take the other side of the trade. We've been running 50s, so if we get below 67.50, then 66.50 is on the table. We are underneath 68.50, so that offers 67.50. In between 750 and 650 is the 200-day moving average. It's got a lot of structure of its own. We can cut through it. There's no reason to think that we're going to stop right there, right on a dime. We could easily overshoot that. But I would expect a reaction like touching a hot pot, right? Jerk back whether you like it or not. Price tags this thing, even if we overshoot it, I would expect some sort of reaction back the other direction. Now, how strong that reaction is and how long it lasts, well, that's up for debate. Running OCR. Those are higher lows. These two are higher highs. This one, not yet done, so we could see a higher high there. OCR is sort of a newer style of analysis called one candle reversal, OCR. It's been around for like maybe 10 years. So keeping our eye on yesterday and on Wednesday, see if we can break those two lows, put in a lower low. And if we do, then we want to challenge this big bar here. That would be March 3. You can see we're already through the midpoint of that bar. That puts us in a bearish posture already. And the 1, 2, 3, 6 of that is the 200. So yeah, if we get down below 67.50, challenge that low, break that, we're going to the 200. Got a nice spread in the moving averages, by the way. They're all fanned out really nice. They got a good curve to them. This is established at this point. Now, that can all change. You can see back here we were established well, and then the 3-day flattened out when price stalled. So, you know, we haven't stalled yet. The 3 hasn't flattened out yet, but that's what we would be looking for. And it could happen with the low that we've already got. We don't need to break down. We don't have to break down. It doesn't owe us anything. So we could just base here, and this low that we've been fighting, it could hold. If it does, we'll flatten out that 3-day, and we'll look to get that crossover and eventual run back up. Otherwise, if it doesn't hold, then game on to the downside, and we'll come down and hit those levels we were talking about. It is possible for us to just expand, break out of all this trash, and make a move to the upside. That is absolutely possible. But it would take one heck of a headline. And it's not going to be an economic calendar event like non-farm payrolls. It's going to need to be something off the books. We're in between the ADRs. Although we are getting close to the lower ADR, we're going to need to get an inside day breakout to get there. We've got hedging this morning, so even though they are participating at 3 times the average volume, they're not sitting out, which is a little odd. Usually, if they're going to hedge, they sit out and hedge. This calls into question whether or not we're going to get a big bar. On the one hand, if they're worried enough to hedge, then it's very possible we're going to get a big bar because they're really worried about a big move. But on the other hand, the big bar happens when people are caught offsides and then they're scrambling and they're all trying to hit the bid or they're all trying to hit the ask and they push and the bid ask gets spread really wide and we get those waterfalls or those big spikes. But if they're hedged, they don't need to chase it. They're not offsides. It won't matter what direction we go. They're fine, and then we shouldn't see them all chasing after the bid or the ask. So it's kind of a catch-22 on that one. This is not my opinion. I'm not guessing or assuming. I'm just telling you they are hedging, and they're always hedged, right? That's a fact. They're always hedged. This is extra hedging, above and beyond the average, and it's nothing but cost. And these greedy fools would not spend that money if they didn't think it was warranted, right? They're protecting something and they're willing to spend money to do it. and there's no making their money back. They're going to lose that money, but they still think it's worth it. Which is another reason for us to really watch the clock today at 8:30, because that's where the drama and the fireworks are headed. Today's floor pivot is lower than yesterday. That's bearish. Price opened underneath it. That's also bearish. We cut up through it, but we wasn't able to sustain that. We came back down through it. That's also bearish. The channel is narrower than yesterday's, but it's still a fairly wide channel, all things considered. A wide channel implies if we break out that it doesn't stick and that we come back in again. This is narrow enough that we could keep the breakout and run. Just keep in mind that it can be so narrow you don't even see a channel, you just see a pink line, and it's not that narrow. But it is narrower. Instead, what we want to focus on today is the S&R lines. So you can see to get S1, we're going to need that inside day breakout. We would get the breakout, get the ADR half, and then hit S1. S2, 67.11, all the way down here, it's a cog line. That lines up, looks like a low on the week. Yeah, Tuesday was the lowest day of the week. So we would get a breakout below Tuesday's low to get to S2. And for R1, R1 lines up really well with yesterday's Globex high. It's not perfect, but it's darn close. Then the weekly floor pivot, and then an escape on the week. And we've got R2 basically 69.60. All right, we've got multiple distributions this week. That's not really helpful. We're getting a lot of support, like technical support. Like we're getting a lot of assistance. That's a better word to use. Down here in this lower zone, but we're nearing the end of that assistance. We break through the value area low, it gets really thin, and we can move through thin areas quickly. There's nothing down here to support us or help us or assist us, and it can get ugly quick. Remember, 67.50 is our line in the sand that we're aiming for. Right now, the door is open for us to go there. Once we get underneath it, it opens the next door, 66.50. 10-day, 30-minute volume profile and TPO. We really don't have anything at this point. We're still waiting to get rid of this bump up here. It's going to take another half of a week at least. We're sitting in the zone. We're underneath the point of control. So any solid move to the upside is going to have to get through that 68.85 area. No new VPOC from yesterday. We've crossed through that zone multiple times. 69.20 still has one parked up there if we happen to get that really crazy push today. Not expecting it, but price can do whatever the hell it wants. Lots of distribution last night in this upper zone, which makes sense because that's where we spent the most time. And the day is half done. We spent, half of it already? Half of half a day up here. So that makes sense. Got a lot of structure in this lower zone, 67.92 cog line. I wouldn't try to zoom on it with a single line in the sand though, right? It's more of an area. So you should be seeing that activity on the tape, pulling and stacking, increased position size, maybe thinning out on one end or the other, get a little bit of trade imbalance. You should be able to see them defending this level. If that defense stops or they just pull the rug, then we should be able to dump right down. Otherwise, flipping it over and taking everything back up, we've left some distribution, so we're going to have to work through those zones. Not really much to work with at this point. And we are ready for next week. As usual on Fridays, we get a bit of a preview of what next week's range looks like. Now, this isn't set in stone yet. It's still moving. It will move all day today, and at some point after the close, it will lock into place. For now, it's still alive, and the range is being derived by the trades that are coming in. So this isn't based on, how far we've moved and rate of change and moving averages, none of that stuff. It's based on trades that are open right now, trades that are being put on. Volatility and time. What I like to do on Fridays, even though this range isn't set yet, is measure it and compare it to the week that we just had. And what I'm looking for is next week's range larger or narrower than the week that we just had? Since volatility and time are two of the key components, we look at how many days in the trading week we had. This was a 5-day week. Next week is a 5-day week. So the weeks got the same amount of days. And yet, next week is much wider than the week that we just had. So the market is pricing in some serious volatility for next week. Typically speaking, calendar events don't cause volatility, they suppress it. CPI, PPI, FOMC, non-farm payrolls, these sort of events suppress volatility. The market expects to go sideways into that event, right? So the really wide range for next week is not very likely. It's not based on some calendar event. It's based on something else. The reason I like to do this on Friday is now I know between now and Monday, I need to dig around and find out what's up with next week, right? It could be something as simple as a big AI conference in Nevada. You know what I mean? It doesn't have to be anything nefarious. It could just be some really big event. In the past, I've seen it be Bitcoin events, AI events. Of course, headlines and war and that sort of stuff can also cause these sort of wide ranges. Seeking Alpha comes out with that weekend edition podcast where they talk about the week ahead and the various events that are coming up. So you can find that podcast. It's free. It doesn't cost you anything. But something's coming and they're pricing it in. So that's kind of the takeaway, right? Next week is not a hurry up and wait week. Next week is a oh dang, what's causing this kind of move week. So the yesterday's 111 trade that I like so much, probably not going to want to use that one too much next week. At least the market is saying we're likely going to break out of the previous day's range a lot next week. It's what's on the table so far. Now, this isn't set in stone, so who knows? By the end of the day, it might narrow up and it might just close like any other week's close. We'll look at it again on Monday and see what we did end up with. We're 1% below the 10-day. That's about the normal turning spot. If we're going to flip things over, it usually happens around this zone. We can go deeper. There's plenty of examples of that. But when we go deeper, we very, very often get a sharp reversal. So, that mean reversion that we talk about so often, right? It doesn't have to. We can make those big moves to the downside and stay down. But more often than not, if we expand below, say, 1.5 and we get into a -2, we're talking about 2% below the 10-day moving average. That is very often a sharp reversal back the other way. If you want to visualize that, it's when the bungee cord is stretched to its fullest and the person on the end of it is about to get flipped the other direction, strong, sharp, fast. Maybe they leave their shoes behind, kind of thing. And for the week, 1.3% below the 10-week moving average. As you can see when I zoom out, that is nothing. That's why there's no risk here yet. It's not like we need to get all bared up and get excited. Yeah, we're down a little bit. Yeah, not a big risk, not a big problem at this point. Things would have to get a lot worse before we start to get concerned. Now, don't get me wrong, you should be defensive, but I wouldn't try going out there and selling the boat. Right? So 1.25% below the 10-week is not usually a stopping point that sticks. You can see very often we get down to this level and we go lower than that. Now there are times where we've turned around and we've came back up after just 1.25, but usually it goes a little deeper. If we're down like this, we usually get a little more. So we'll have to see how it plays out. But I wouldn't stress being down 1.25 below the 10-week. That's not a big deal at this point, especially when we're still IX10. So just breathe. Looking at what's down this morning, we've got gold miners, Bitcoin, airlines, chips, uranium, generic tech, Mag 7, banks, everything down this morning. Uranium, growth, industrials, quantum, financials. Looking at what's up this morning, that might be a shorter list. We have generic energy, a little bit of China through the KWeb group, and the Mag 7 down volume is up with Nat Gas and the VIX. The VIX is up 19% in a 5-day period, and the dollar's flat. So if we're looking for that move, let's get the data in first, see what we're going to get out of that data. You got yesterday's RTH, but for the low, all of yesterday and yesterday's RTH are the same thing, so that's not an issue. If we break that low, we got the expansion to the downside and the opportunity to test the low of the week, 67.20, and then 6,700, and then 66.50, because we're running those 50s. Otherwise, we want to start working our way back up through this zone. So cut through the Globex mid, back to the top, yesterday's RTH high, and then all of yesterday's high, level by level. And it's so wide. I mean, it's a pretty good run, right? We're talking about 120 points. There's plenty of room in there to have a decent run back up and get to yesterday's high. Plenty of room. If we do run all the way back up and challenge yesterday's high, I don't expect more than that. So I would be looking for a 111 up here or a 1236 up there because we're talking about running all the way back up, right? So 130-ish points getting up there and then getting a breakout on that into 69.32 at the most. And then that should shut us down. It's also breaking out on the week. It's a new high on the week. That would get us into the 111 anyway, 69.11 cog line. So if we do get up there, I'm not expecting to get outside of my reversal zone here. All right. So that's what I got for you guys. Be careful, be safe, watch the clock, have a good weekend. I'll see y'all Monday.